Pepsi, here we are. They're dividend king. They've got 53 straight years of growth. They're trading at 5-year lows, and they've got a record high yield of 4.3% right now. So it's really hard to ignore.
I think the Trump administration is going to be pro-growth. It's going to, help consumers feel better. I think consumer confidence is a factor.
There's a private, members-only club for stocks. And the price of admission isn't a high stock price or some flashy new technology. It's time and it's consistency. To get in, a company has to give its shareholders a raise, a higher dividend, every single year for 50 consecutive years. That's 5 decades of uninterrupted dividend growth through every market crash, recession, and global crisis you can think of. This elite group is called the Dividend Kings, and sitting right near the head of the table is a company you almost certainly have in your kitchen, PepsiCo.
We think investors possibly were lured away by treasury yields going higher, and Pepsi is just that traditional dividend growth company.
For 53 straight years, PepsiCo has increased its dividend, cementing its status as corporate royalty. But this isn't some dusty history lesson. This is the story of how a simple beverage company became a global food and beverage empire, creating a fortress of cash flow that has rewarded investors for generations. We're going to break down the strategic move that left its biggest rival in the dust, look at the financials that make its dividends so reliable, and analyze the challenges it's facing right now. Because the real question isn't just how PepsiCo became a dividend king, but whether its royal status still makes it a solid foundation for your portfolio today. A tale of two empires. To understand how PepsiCo became the giant it is today, you have to go back to the 1960s. Back then, Pepsi was a distant second in the cola wars against its arch-nemesis Coca-Cola. While Coke was laser-focused on dominating the world's beverage market, a sharp marketing executive at Pepsi named Don Kendall had a revolutionary idea. He saw a future that wasn't just about what people drank, but also what they ate. In 1965, a decision was made that would change the company's path forever. Pepsi Cola merged with a successful, but not yet famous, snack food maker from Texas called Frito-Lay. On the surface, it seemed like an odd pairing, a soda company and a potato chip company. But Kendall knew something fundamental about people. They like to buy a drink with their salty snack. It was a perfect marriage. This one move was a strategic masterstroke. While Coca-Cola was busy fighting a one-front war on the beverage aisle, PepsiCo had quietly opened a second front in the snack aisle. This created a much more resilient, diversified business. If drink sales were slow, the booming snack business could pick up the slack, and vice versa. This wasn't just a merger, it was the construction of a financial moat. Over the next few decades, PepsiCo kept building its kingdom, not just by growing organically, but by making smart acquisitions. It bought Tropicana, getting a major foothold in the juice market. It acquired the Quaker Oats Company, which brought the iconic oatmeal brand and a hidden gem, Gatorade. The Gatorade deal was transformative, giving PepsiCo total dominance in the hugely profitable sports drink category. This relentless expansion created a portfolio of iconic brands that you can find in almost every corner of the supermarket. From Lay's, Doritos, and Cheetos in the snack aisle, to Pepsi, Mountain Dew, and Gatorade in the coolers, to Quaker oatmeal for breakfast. The company built an empire that serves consumers at every part of their day. This dual engine of snacks and beverages is the bedrock of PepsiCo's success. It gives them incredible negotiating power with retailers. When a PepsiCo truck pulls up to a grocery store, it isn't just dropping off soda. It's stocking the most valuable real estate in the store, the snack aisle, with the world's most popular chips. This gives them leverage that beverage-only companies can only dream of. That historical decision to diversify, to be more than just a cola company, is the first chapter in the story of how PepsiCo built an empire strong enough to earn its royal dividend status. The kingdom's riches. So how does this empire create one of the most reliable dividend checks on the market? The answer is in the power of PepsiCo's economic moat and its unwavering commitment to shareholders. First, that moat. An economic moat is a competitive advantage that protects a company from its rivals, just like a real moat protects a castle. PepsiCo's moat has 3 massive walls. The first wall is its portfolio of monster brands. We're talking about a global lineup that includes over 20 different brands that each generate over $1 billion in annual retail sales. Think about it. Lay's, Doritos, Cheetos, Gatorade, Pepsi, Tropicana, 7UP, Lipton. The list goes on. These aren't just products, they're cultural staples. This brand recognition creates incredible pricing power, letting PepsiCo pass on rising costs to consumers more easily than smaller competitors. The second wall is its unmatched distribution network. PepsiCo runs one of the largest and most sophisticated direct store delivery DSD systems on the planet. This means they have their own fleet of trucks and their own people stocking shelves in millions of stores, from giant supermarkets to tiny corner shops. This DSD system is a massive competitive advantage. It makes sure their products are always in stock and perfectly displayed, and it gives them real-time data on what's selling. For a competitor to even try to replicate this would cost tens of billions of dollars and take decades. It's a barrier to entry that's almost impossible to overcome. The third wall is its sheer scale. As a global giant with nearly $92 billion in annual revenue, PepsiCo's size gives it huge cost advantages. They can buy raw materials like corn, potatoes, and sugar at lower prices than anyone else. They can negotiate better advertising deals, locking in prime ad slots during events like the Super Bowl, for a fraction of what a smaller company would pay. This scale helps them maintain healthy profit margins, even when competition is fierce. These three walls, brands, distribution, and scale, create a fortress that generates a staggering amount of cash year after year. And that river of cash is what funds its legendary dividend. Let's talk about that dividend. For 53 straight years since 1972, PepsiCo has given its shareholders a raise. Through the high inflation of the 70s, the dot-com bust, the 2008 financial crisis, and the 2020 pandemic, that dividend check kept getting bigger. The compound annual growth rate of the dividend has been about 6.5% since 1972, consistently beating inflation. In early 2025, the company announced another 5% increase, bringing the yearly payout to $5.69 per share. And here's where it gets powerful, the magic of compounding. Imagine you invested $10,000 in PepsiCo 10 years ago and reinvested every dividend. That $10,000 would have bought a certain number of shares. Over the decade, those shares would have paid you dividends, which you would have used to buy more shares. Those new shares then start paying their own dividends. It's a snowball effect. Today, your investment wouldn't just be worth more from the stock price, your annual dividend income would have grown dramatically, giving you a real, growing stream of passive income. Of course, a dividend is only as good as a company's ability to keep paying it. The key metric here is the payout ratio. What percentage of earnings are paid out as dividends? PepsiCo's payout ratio currently hovers right around 80%. While that might seem high, it's typical for a mature, stable company like PepsiCo. It shows both the ability and the willingness to return the majority of profits to the owners, the shareholders. For income investors, this isn't a warning sign, it's a statement of purpose. Challengers to the throne. No king reigns without challenges, and no stock analysis is complete without a clear-eyed look at the risks. It would be naive to think PepsiCo is invincible. The company is navigating some serious headwinds right now, and any potential investor needs to understand them. The biggest long-term threat is the global shift toward healthier living. For decades, PepsiCo's empire was built on sugar, salt, and fat. But today's consumer is more health-conscious than ever. The war on sugar is real, leading to new taxes, ad restrictions, and a drop in full sugar soda sales in developed countries. At the same time, the salty snacks at the heart of the Frito-Lay business are facing pressure from people looking for cleaner labels and healthier options. This is already showing up in PepsiCo's numbers, with recent earnings reports showing some softness and volume declines in North America. The second major challenge is the economy itself. Inflation has driven up costs for everything from potatoes and corn to aluminum cans and the fuel for their trucks. While PepsiCo has strong pricing power, there's a limit. If they raise prices too much, consumers might start switching to cheaper store brands. And as a global company that gets nearly 40% of its revenue from outside North America, PepsiCo is exposed to geopolitical risk and currency swings. A strong US dollar can hurt the bottom line, which is one reason the company recently had to lower its earnings forecast for 2025, projecting that core earnings per share would be flat for the year. The third challenge is just fierce competition. In drinks, the war with Coca-Cola never ends. But the battlefield is bigger now. Companies like Keurig Dr. Pepper and a wave of agile startups are constantly innovating in sparkling water, energy drinks, and coffee. On the snack side, while Frito-Lay is the champ, it faces pressure from global players like Mondelez and from store brands that offer similar stuff for less. Recent recall issues at Quaker Foods have also created a headwind and damaged some consumer trust. But a king doesn't just sit there while challengers gather at the gates. PepsiCo is fighting back on all three fronts. To counter the health trend, it's pushing Pepsi Zero Sugar hard, launching the successful bubbly sparkling water line, and acquiring healthier brands like Bear Snacks and Popcorners. Their strategy aims to evolve the portfolio to be better for people and the planet. To fight economic pressures, the company is using its massive scale to drive cost-saving initiatives. And to fend off competitors, PepsiCo continues to invest billions in marketing and innovation to keep its core brands on top. The strong performance of its international business, especially in emerging markets, is still a key growth engine that helps offset some of the weakness in North America. The verdict: a bedrock for your portfolio? So after a tough year that has put its stock under pressure, is PepsiCo a great business on sale or a falling knife? Is it still a solid foundation for a long-term portfolio? To answer that, we have to talk about valuation. A great company bought at a terrible price can be a terrible investment. For most of the last decade, a big argument against buying PepsiCo was that it was expensive. The recent challenges have changed that picture. Let's look at the price to earnings, or PE ratio, which tells us how much investors are willing to pay for the company's earnings. As of mid-2025, PepsiCo's stock trades at a PE ratio of around 17 to 19. That's way below its 5-year average, which has been closer to 26 or 27. Put simply, compared to its own recent history, the stock looks cheap. Now let's compare it to its chief rival. Coca-Cola is currently trading at a PE ratio of around 25. This means you're paying a big premium for Coke's earnings compared to PepsiCo's. The story gets even better when you look at the dividend yield. Because its stock price has fallen, PepsiCo's dividend yield has jumped to over 4%, near a historic high for the company. Coca-Cola's yield, on the other hand, is much lower at around 2.8%. From both a valuation and an income standpoint, PepsiCo looks like the more attractive opportunity right now. The bull case is clear. You have a chance to buy a certified dividend king with an incredible portfolio and an unbeatable distribution network at a valuation well below its historical average. You get paid a handsome, growing dividend of over 4% while you wait for the company to work through its short-term issues. The bull thesis rests on the idea that the current headwinds are cyclical, not permanent. The bear case is that these challenges are more serious, that the shift away from sugary drinks and salty snacks is a permanent trend that will lead to years of slow growth. Bears will point to the revised guidance as proof that the kingdom is starting to crack from the inside. So what's the verdict? For the true long-term investor, the kind who thinks in decades, not quarters, the current situation looks less like a crisis and more like an opportunity. PepsiCo is the definition of a blue-chip stock. Its financial foundation is a rock, its brand power is immense, and its commitment to the dividend is basically set in stone. The stock has weathered far worse storms than this one over its 53-year reign as a dividend grower. Buying PepsiCo today is a vote of confidence that it can adapt, just like it has before. It's a belief that the company smart enough to merge soda and chips will be smart enough to navigate the shift to healthier options. It's not a stock that's going to double overnight, but it is the kind of unshakable foundation that a durable, income-generating portfolio can be built on for years to come. PepsiCo's journey to dividend king status wasn't an accident. It was the result of a visionary strategy, relentless execution, and a clear focus on returning value to its owners. It's a powerful lesson in what it takes to build a business that can truly stand the test of time. Now I want to hear from you. What's your take on PepsiCo? Do you see the current price as a buying opportunity, or are the risks too high? Let me know in the comments below. And of course, if you found this analysis helpful, make sure to hit that like button and subscribe for more breakdowns that go beyond the headlines. Thanks for watching.